Good afternoon, good evening, everybody. Welcome to 12-Minute Trading. This is our live market update. Today is Monday, the 17th of October, 2022. Whether you're joining us live here today or whether you're watching this later on a replay, welcome aboard. I'd like to welcome you to 12-Minute Trading. My name is Doc Severson. I am joined over here with Dave Lukas, the founder of 12-Minute Trading. And we got a lot going on in the market these days. What are you seeing these days?
Well, here we go again, right? So what did we have? We had Thursday last week, up 100 plus points on the S&P, and then Friday gave it all back. With a smidgen higher, right? That's how we ended the week. And the thing that we talked about, it was interesting enough that we still basically had gone nowhere since the end of September. We basically been walking sideways. Basically, where we ended last week was where we ended the month of September. So really like 3 weeks walking sideways, which is somewhat of a bottoming formation. And that's something we've been talking about. And now we come into this week and we've got a weekly chart. We talk about our fractal energy a lot. If you watched our videos before, fractal energy is our proprietary indicator on how we track the energy in a chart to trend. And the weekly chart is exhausted. The daily chart or the weekly chart's almost exhausted. It's getting there, but the daily chart has almost full charge, right? And so is today the beginning of that daily trend? Well, after what happened last Thursday, Friday, it's too early to tell, right? If it follows on to the rest of the week and we start to see our daily energy chart, which Doc will bring up here on the screen in a minute, start to bleed that energy out and continue higher, that tells us we're getting that daily swing. And those last usually 5 to 7 trading days, sometimes 10. So that's kind of where we're sitting at. We're just waiting for it to confirm the direction. But today was a good start to kind of move up off that bottoming formation that we've been seeing for the last few weeks now.
Yeah, it's interesting because Thursday was one of the biggest reversal days we've ever seen in the market, where we dropped after the CPI number came out and was disappointing. We saw the market drop 150 handles in the pre-market off of the pre-market highs. Like we just never see price movement like that happen unless it's at the extremes, right? So, but just when everybody was super bearish for the morning, like, oh no, here we go, here comes the crash, we rallied right up to the top of the, and so of course, when everybody flips to bullish, what happens on Friday? We just, we find a way. All we need is a Fed speaker to start, jumping on a microphone, and that it's over at that point, because we dropped and we closed at the lows of the day on Friday. So a complete reversal from what we saw during the cash session.
Yeah, the market continues to do the opposite of what everybody expects it to,
Yeah.
which is the modus operandi of the markets, right? So the it's amazing to me, like coming into this week, everybody's still, it's like 3-1 put to call, right? And so you've got everybody on one side of the trade. So which way does the market go? It goes the opposite direction.
We are seeing some
And
absolutely extreme sentiment values, like put to call ratio. We're starting to see the panic versus euphoria index completely. I mean, just, this is one of the lowest values in the last 30 years that we've seen. So I guess in a way, what Dave and I are saying is that we kind of think that this might be an intermediate bottom that's being hammered out right now in the short run. By no means do we say that the bear market is over, but this might be a place where we might see some volatility releasing back up to the upside, because we're getting a very crowded short trade right now. And this could also release very quickly to the upside with all those puts in play.
Well, and there's some other things that working too. We talk about the energies. The monthly energy, and we've talked about this before, has been fully charged for a while, and it's just ticking down a tiny bit. I don't put too much stock when it first starts to tick down. I usually let it's got to go a couple months and really prove its trend, because remember, the monthly chart's the largest time frame, right? Every tick on there is a month. So those trends play out over 5, 7, 8, even 10 or 12 months a lot of times, right? It takes that long to bleed that energy out of that chart. So to have it be fully charged and start to tick down a little bit, and see kind of, we're seeing October now being a good positive month. We'll see how it ends, right? Is interesting to watch, but it doesn't confirm anything yet. Doc, I always like to talk about things from a macro standpoint, but one of the things that you and I've talked about for years, and I love it, is the four phases of the market, right? So there's disgust, disbelief, acceptance, and then euphoria. I think we would all agree that for quite some time we've been in disgust, right? The S&P's down 25%, the Nasdaq's down 35%, and so on. And we're used to these quick reversals, right? We got that in the pandemic, right? Everything crashed, but gosh, within less than 5 months, we were back up and running to new highs again. So we're spoiled that we're used to that, right? So now we've been kind of sitting in this malaise and this area for now 9 months coming on or so, 10 months or longer. And so I think people have been squarely in disgust. So is this the point? Because usually what happens in like a market like this is that the market rallies in disbelief. Nobody believes that the market's going to sustain a rally, or it's just another one of those relief rallies and it's going to roll right back over and we're going to S&P 2000 and so on. So are we at the beginning of what would be the disbelief that ultimately leads to acceptance and back to the run up again? And that plays out over time. So from a monthly chart standpoint, maybe we have that. Maybe we're at the beginning of the disbelief stage. What are your thoughts, Doc?
Well, on the monthly chart, I would agree that we're definitely into disgust on the monthly chart. But if we get into something like even the weekly or even the daily, like on a day-to-day basis, like Thursday, we got into euphoria for a whole day, right? So it depends on the time frame that you're looking at.
Yeah.
So we definitely had a disbelief rally in the month of July into mid-August. It was disbelief. We actually retraced 50% of the drop up until that point. And so people were looking around going, oh, it's over. It's over. And I remember exactly going through the same thing back in the spring of 2008. Oh, it's all over. In fact, even back then, you know what they were calling it? They're calling it a cub market. They were saying, well, this is no big deal. It's not even a bear market. It's just a cub. And little did we know. And that's what colors my opinion right now, is that we are going to see these screaming rallies to the upside. But the markets have a way of punishing those that are hopeful. And so we're just going to go back and forth between this. So it becomes very much a trader's market through something like this. It's no longer an investor's market.
Swings to trade.
Yeah, we are going to punish every single investor that's out there before they finally give up and puke out at the bottom. And then, when that is all over, when people say, well, I'm never going to buy stocks again, that's when we're going to see the rally off the bottom. So kind of bottom line here, I'm thinking that we're going to get a quick reversal, intermediate. Maybe we'll get a month or so. Maybe we'll get into
through the election.
Yeah, through the election, and maybe some euphoria after the election. Like, okay, everything is going to change now. I'm being assumptive here, but I think with good reason. And then
just in time for the next CPI number to come out.
Absolutely. Let me walk you guys through just 3 quick scenarios here. I'm gonna go over here to the charts and dig out the magic pen for a second. So what I'm thinking here is that we are so very close to exhaustion, and the market's already starting to work itself into consolidation, range expansion, range contraction. There's 3 scenarios that I think will become very evident within the next couple of weeks. One would be a bear flag, and this is just going to be about a 300-point range. It's, from day to day, it's going to be, the issue will be at doubt almost every day. It'll be up, down, up, down, up, down, but it's going to stay within the very defined range. If it shows up like that, if we just consolidate like that in the near future, probably bear flag, probably going to be releasing much, much lower. So that's number 1. Number 2 and 3 do share some properties here. Number 2 would be we rocket off the bottom. And again, this is going to be disbelief rally into euphoria very quickly, because we're going to be up at 4,000 and everybody's going to be high-fiving and saying this is all done. That will lead into, well, this will probably, and I'll just do this on the daily here. Here's the 200. This will come up to the 200, set up a lower high, and then get tomahawked. So that's scenario number 2, and that will pull in, once again, a whole pile of new investors wanting to go long, thinking that it's all over. and they're going to be destroyed, much in the same way that August destroyed 19% of the value of the S&P. Scenario number 3 is the one that I'm most interested in. I give this the lowest probability of all, but scenario number 3 would be very similar. We skyrocket right up to the 200, and this trend line here that I think you can barely just see like that. Okay, so we skyrocket up to there. The price pulls down, and then everybody says, oh, it's all over. Oh, boo, let's go short again. Let's buy puts, and we'll see this thing absolutely destroy that trend line. So this could be if the Fed does something unexpectedly beneficial to the market, which I'm not sure if they're in position to do. So this is why I give number 3 the lowest probability of this. But these are the only 3 things that can happen at this point, and it's for us to kind of figure out which of these has the highest probability of happening. So that's the way we look at things. Again, we're not predicting the future. We're just like laying out evidence and collecting evidence and saying, well, based on what we're seeing, this is likely what's happening here.
Yeah, the easiest thing right now is just kind of that bear flag scenario with you get a nice little rally up and, it's nobody believes it, which keeps it going for a little bit longer until they start to think that it's something. And then it falls back down. You go to new lows. And that's typically, if you follow the 2008 analog, what you would have seen. You'd see that this next kind of bear rally back up, and then it would roll over into the lows of the entire bear. That malaise will last for several months. That would take us into the spring of next year, April, May, by the time things kind of finally shake out and then start to go up. And that could align with the Fed's trajectory. I think the Fed itself is it's going to be pretty tough to raise rates past the next couple meetings in any meaningful way, simply because the United States can't afford the interest on the debt. With all that debt rolling off that's getting repriced at the new interest rates, you're going to run into a problem really fast there. So I think the Fed probably and maybe that is something that it comes in for scenario number 3. The Fed comes out in December and says, that's it, we're done. We're going to take a pause. We're not planning any new rate hikes in the next year. And, markets love that. And, that brings certainty to the markets, and they can continue, forward from there. So remember, the market's a forward-looking instrument. It loves certainty. That's why an election actually where the other party wins is good, because then it's a stalemate, right? Markets love that because nothing goes anywhere, nothing gets done, and everybody can plan on that. So think in those terms. What's going to bring the market the most amount of certainty? Look for those things, and if those start to happen, that'll give you some insight into the future.
Something else that we really haven't discussed yet is the exogenous risk factor. Something happens overseas that is not priced into the market. And I don't think it's going to be, if you look back over the years, all of those risks that we knew about, and we chewed our fingernails on it, and we like worried about at night and things like that. None of those ever really played out. Right. I'm trying to think of some of the ones that were well known, like around some of the taxes coming into play, like 2012, 2013. Do you remember what we called those? It was like the fiscal cliff. Yeah. Do you remember the fiscal cliff?
The fiscal cliff.
Like everybody was like, oh my God, the fiscal cliff is coming. What happened in 2013? The market shot up 35%, right? So all of those things, like obviously there's some concern about war overseas, but it's one of those risks that everybody sort of knows about, right? It's always the unknown. It's always the flyer from left field that torpedoes the market.
What's not priced in, right? It affects the future.
And that can work both ways too. That can work both ways.
Well, and think of it in this way. So right now, the fear is Putin going to drop a tactical nuke in somewhere, right? So he drops a tactical nuke in, the market's going to crash overnight because uncertainty. What's the response? What's going to happen? All these different things, right? But what's the opposite of that? Putin doesn't do that. Maybe they come to an agreement and end this thing, and the market skyrockets higher, right? So there's all these things that are always on the periphery, right? There's always something on the periphery that can move markets. That is the unknown, and those are what create the black swans and stuff. But if you trade out of fear of that, you're never going to go anywhere because you're never going to trade, or you're not going to make any money because you're trading scared. And anytime you're trading scared, you lose.
Yeah,
And so,
three years ago, the only experience that we had trading around an unknown virus was Ebola back in 2014. And Ebola back in 2014, my attitude at the beginning of 2020 was, this is no big deal. This is we're just gonna drop a little bit and bounce right up, and we'll get past this, and we'll figure out and I think a lot of people were in the same boat until Bill Ackman went on CNBC and basically, advised the whole country to shut down, and all of a sudden everybody's like, holy crap.
Even worse, that actually did affect things, was swine flu. And remember the swine flu whole deal. But markets didn't really shrug that off. Some one day wonder type things, like what we even saw last week, type movement, but it got past that in a hurry, right? So again, it's got to be pretty significant. It's got to really, really alter the future in the market's eyes. The underpinning of the market's still earnings. Earnings have been good. That's helping this, right? Bank earnings have been really good so far. We got Netflix tomorrow. We got some other ones. So if we see some of the tech guys start to have some good earnings again, that's going to bring more fuel to this fire. And so earnings is still a driver of the market.
And then we go right into the election. So this could be an interesting period. Again, if you go back in 2008, we sold off into the end of October, and then we rallied actually for a week into the election in 2008. And then we sat around and said, okay, now what? Sell. And so,
well, as of right now, we aren't at a systemic, financial risk where the whole world financial system is going to go down. So we got that going for us. We'll see what happens tomorrow, though.
Yeah. Well, okay. So if anybody's out there has any questions, please go ahead and chat them in while we wrap things up here. But it's, bear markets are always difficult. It's always the transition into a full bear that, because it did not pay you anything at all in the last 15 years to be bearish. It paid you to stay the course. And then here's a fat tail event that comes along, which is a true bear market, right? So we deal with it. We adjust. We don't overreact. We just, we learn to be much more contrarian and to be more introspective about what the market is doing. And then at some point, someday, there will be positive drift back into the market again. So we know that if we just hold off, if we just, he who loses the least during a bear is the one that's set up best for long-term success. So that will come back.
The only other thing I can say to that is, we've shifted our strategies to more short-term, and short-term is working really, really well in this market. We continue to rack up wins every single week, like on our target 100 and double strategies, because we're trading short-term. We're going higher probability, right? We're trading, we're doing more frequency than we used to, but because of, higher probability. So we're not, getting as much up front as we used to when we're selling options, but it's consistent. It's like water dripping on a rock, right? And that's the key in anything when markets shift, is to have strategies that you can adjust to work in any market. The principles have all stayed the same. It's just we've adjusted, how we do them and the timeframes we do them to make them work, right? And I think that's a key thing if you're building a strategy, or if you're just even looking at your current strategy on how to make it better, is to remember the principles, but see how they adjust to the current market type that you're in, and make your adaptations accordingly.
Yeah, if I'm going to go kayaking, I want to go downhill, downstream. I don't want to have to paddle upstream, although it looks really cool when these guys get in these eddy pools and they go up. So we want to just be trading with the character of the market, and just taking the easy route on things. Gravity does work. So, find out the character of the market, find out the character that you're working with. And right now we have not excessive, but pretty good implied volatility to trade with. We're getting some good distance on our trades right now. They're not particularly stressful. We're not playing hand-to-hand combat with them. And, we're in a nice groove now. So if you are not part of 12-minute trading, please drop us a line or continue to watch these. Make sure you subscribe to our channel here, and over time we'll show you what we've got, and any questions, go ahead and fire them in. Otherwise, I think that's it for a Monday. Any final comments, Dave?
Sorry, I was a little bit delayed for some reason. Yeah. Final comments. You were just mentioning if you go to the 12-minute trading site, you actually can get a free ebook on how to build a winning trading strategy and everything right there from the site. So if you have interest in doing that, you can check it out. Also, it gives you a way to get like 2-week free trials of our services and things like that if you want to check things out. So thanks for tuning in, everybody, and great to see you as always. We'll see you back here next week and then through the week in our market minutes and everything else that we do.
All right, everybody. Thanks very much for tuning in and watching this, whether you're live or on replay. And we'll see you in the next live market update. Take care, folks. Bye now.